All right, let's dive into a really interesting one today. Southern Alliance Mining. Their latest financial report for 2025 is, well, it's a bit of a head scratcher. You've got growth on one side, but then these huge losses on the other. It's like two completely different stories rolled into one, and we're going to figure out what's really going on. So here's the big question, the puzzle at the heart of all this. How in the world can a company's revenue shoot up by 20% while its losses just explode by over 1,000%? I mean, those numbers just don't seem to belong in the same sentence, right? It feels like something's missing. So let's dig in and find out what that is. Okay, here's how we're going to tackle this. First, we'll lay out the financial puzzle itself. Then, we'll unpack this huge paper loss. That's the key. After that, we'll look at the real growth story that's kind of hidden. We'll also cover their big strategic pivot and wrap up with what this all means for their bet on the future. All right, part one, the financial puzzle. Let's get right into these headline numbers that, honestly, look pretty contradictory. Okay, take a look at this. The contrast here is just wild. Up top, you've got revenue. It's up a solid 20%, almost hitting 200 million ringgit. That looks great, right? You'd be celebrating that. But then you scroll down. Gross profit down by almost 66%. Ouch. And then you get to the real shocker, the loss before tax. It went from a manageable 2.5 million loss to a massive 31.6 million loss. That is a 1,157% jump. Seriously, what is going on here? So that leads us right into part two, unpacking the paper loss. Where did all that money go? Well, the key thing to get here is that not all losses are, well, real losses in the way you might think. So the biggest piece of the puzzle is this number right here, 18.9 million ringgit. This is what's called a non-cash impairment loss on their mining assets. Basically, the outlook for iron ore prices got a bit gloomy. So accounting rules say they have to officially lower the value of their mines on paper. No cash actually went out the door, it's just a bookkeeping thing. And there's more. Add another 5 million ringgit to the pile. This is the same kind of deal, a non-cash impairment, but this time it's for some joint ventures over in Sabah. Why? Pretty simple, really. The exploration licenses for those ventures didn't get renewed, so poof, the value of that investment on the books has to go down. And the last piece of this specific puzzle is another 2.2 million ringgit. You guessed it, another impairment on a joint venture, this one in Pahang. And again, it's tied back to that same weaker forecast for iron ore prices. The investment just isn't worth what it used to be on paper. So, just to make sure we're all on the same page, what exactly is a non-cash impairment loss? It sounds complicated, but it's not. Think of it this way. Imagine you own a car and you bought it for $30,000. A year later, its market value is only $20,000. You haven't lost any actual cash, but the value of your asset on paper has dropped. That's exactly what's happening here. It is so important to remember that no actual money left the company's bank account. It's an accounting entry, not a cash expense. Okay, so let's put it all together. You take that 18.9 million, add the 5 million, and add the 2.2 million, and you get a grand total of 26.1 million ringgit in these one-off, non-cash losses. And right there, that's the key. If you pull that 26.1 million out of the equation, that scary 31.6 million loss suddenly becomes just 5.4 million. Now that makes a whole lot more sense, doesn't it? Which leads us perfectly into our next section. Now that we've demystified that big paper loss, let's talk about the good news, the positive story of real growth that was buried under those headline numbers. So yeah, iron ore prices were a bit soft, but look at this. The company was selling a ton more product. Sales volume for crushed iron ore was up an incredible 350%, and for iron ore concentrate, it was up 22%. This tells you that operationally, they were firing on all cylinders. They were basically making up for lower prices by just selling way more stuff. And remember that 20% revenue growth we talked about at the very beginning? Well, here's a huge reason why. They got into a whole new game, bauxite. And that new revenue stream brought in over 44 million ringgit this year alone. So this isn't just about selling more iron ore. They're actively diversifying and adding totally new products. Now, this number, this one is probably the most important one you'll see today, 4.4 million ringgit. Despite that giant paper loss we talked about, the company's actual day-to-day operations generated positive cash flow. This means that when you ignore all the accounting write-downs, the core business was still making money. Cash was coming in the door. That's a huge sign of a resilient underlying business. Okay, so these numbers aren't just random. They're happening because the company is in the middle of a major strategic pivot. They're changing their entire game plan to fit the new reality of the market. One of the biggest changes they've made is switching from open pit to underground mining. Now, this is a big deal. With underground mining, you don't have to deal with all the costly waste removal you get with open pits. Plus, your production is way more stable because you're not getting shut down by bad weather. It's a classic case of spending money now to save a lot more and be more efficient down the road. And here's the other huge part of their new strategy. They're jumping into critical minerals. They just bought a 40% stake in a company called MCRE Resources, which is their ticket into the rare earth elements market. And if you're not familiar, rare earths, or REEs, are the secret sauce in everything high-tech. We're talking electric cars, wind turbines, smartphones, you name it. This is a super smart move. They're using what they already know about mining to get into a booming market, and it means they're not just a one-trick pony relying on iron ore anymore. So all of this brings us to the final piece. What does this all mean? This is really a company betting big on its future, and it's right in the middle of a huge transformation. And this quote from the managing director really says it all. He's not shying away from it. He says, look, FY2025 was tough, but then he immediately points to their strong sales volumes and these new strategic investments as the foundation for what's coming next. It's that classic idea of getting through a tough time while you're busy building something bigger and better for the long haul. So, looking ahead, the company feels pretty good about where they're headed. They're on the record saying they expect things to look better in fiscal year 2026. And why wouldn't they? They've got more efficient mining operations coming online and a brand new foothold in the super hot rare earths market. And that really leaves us with the big final question, doesn't it? Their main iron ore business is clearly under pressure. So is this big pivot into rare earths a super risky gamble that takes them away from what they know? Or is it a strategic masterstroke that positions them perfectly for the future? Honestly, only time is going to tell. But one thing is for sure, Southern Alliance Mining is not a company that's just sitting on its hands. Thanks for tuning in.